The butterfly effect originates from chaos theory. Scientist Edward Lorenz discovered an astonishing phenomenon while simulating weather patterns. A tiny change in initial data, just 0.000001, produced entirely different outcomes. To describe this small change leading to big results, he famously said, "A butterfly flapping its wings in Brazil could cause a tornado in Texas." This isn't just poetic imagery. It's grounded in mathematical logic. Complex systems have countless variables, making predictions nearly impossible. Financial markets are particularly prone to butterfly effects due to three key characteristics. One, emotion-driven dynamics. Markets operate on emotions like fear, greed, and expectations, amplifying small events. Point two, strong interconnectivity. Global markets are tightly linked. Bad export data from China can ripple through Europe and hit U.S. tech stocks. Point three, rapid information dissemination. With internet and smartphones, any breaking news spreads instantly, triggering market reactions before full context is understood. Point five, triggers of butterfly effects in markets. Here are 5 common ways butterfly effects manifest in financial markets. 1. Policy changes. For instance, a 0.25% interest rate hike by the Federal Reserve might seem minor, but can significantly impact mortgage rates, corporate borrowing costs, and consumer confidence, ultimately causing stock declines and shifts toward bonds or safe assets. Point two, macroeconomic data. A slight increase, e.g., 0.2%, in monthly CPI figures can signal higher inflation pressure, prompting market sell-offs. Point three, geopolitical events. Conflicts like the Russia-Ukraine war elevate energy prices, disrupt supply chains, and influence inflation and corporate profitability worldwide. Point four, unexpected events. The COVID-19 pandemic began as localized lockdowns in Wuhan, but escalated into global shutdowns within weeks, halting capital flows, logistics, and human movement. Point five, market psychology. Headlines like panic selling surges intensify investor fears, leading to widespread sell-offs and further market collapse. These 5 butterflies are constantly flapping their wings across financial markets. Case 1. The 2008 financial crisis. How did subprime mortgage issues trigger a global financial meltdown? 1.U.S. Banks loosen credit standards, enabling people to buy homes they couldn't afford. Point two, falling home prices reduced collateral value. Point three, mortgages were bundled into securities, MBS, sold to investors. Point four, rising mortgage default rates caused bond values to plummet. Point five, major banks like Lehman Brothers faced asset wipeouts, leading to credit freezes. Point six, global panic selling ensued, collapsing markets worldwide. Each event acted like dominoes. The butterfly flapped its wings, unleashing a storm across global financial systems. Case 2. Silicon Valley Bank Collapse, 2023. Many assumed SVB's failure was insignificant since it was a small regional bank, but they were wrong. Point one, SVB specialized in serving tech startups. Point two, during the pandemic, its deposits surged as startups raised funds. SVB invested heavily in long-term bonds. Point three, interest rate hikes in 2022 caused bond values to drop sharply. Point four, liquidity dried up. Depositors panicked and withdrew funds en masse. Point five, SVB collapsed, triggering fear among other small banks. Point six, market expectations of further bank failures led to steep declines in financial stocks. A seemingly localized issue snowballed into widespread confidence crises across U.S. banking sectors. Case 3. The global chip shortage. This may seem unrelated to finance, but has profound impacts on markets. Point one, pandemic-driven changes in consumer habits increased demand for electronics. Point two, semiconductor factories faced lockdown restrictions, delaying production timelines. Point three, automakers, smartphone manufacturers, and laptop companies struggled with supply shortages. Point four, supply chain disruptions led to revenue declines and stock price corrections. Point five, geopolitical tensions, e.g., Taiwan-China U.S. semiconductor disputes, further exacerbated volatility. Result: tech stocks experienced sharp fluctuations while inflationary pressures influence policy decisions globally. What can we do? 5 risk management strategies. You can't stop the butterfly effect, but you can plan strategically. 1. Accept market irrationality. Emotions often dominate markets. Prepare for unpredictability rather than expecting logical outcomes. Point 2. Avoid relying on single narratives. Don't assume strong fundamentals guarantee success. Markets rarely follow scripts perfectly. Point 3. Set stop-loss mechanisms. Without stop-loss strategies, your investments are vulnerable to sudden downturns triggered by butterfly effects. Point 4. Diversify assets. Spread investments across industries, currencies, and countries to mitigate localized risks. Point 5. Monitor signals actively. Pay attention to economic data, policy shifts, and breaking news. Ask whether these could provoke exaggerated market reactions. The butterfly effect isn't just theoretical. It happens daily in financial markets. Today's inflation data, or bond yields, or even layoffs at one company, could spark large-scale corrections tomorrow. That's why cultivating risk awareness is essential. Adjust your strategies flexibly without stubbornly betting on one direction. If this video helped you understand the butterfly effect better, please like, subscribe, and share your thoughts in the comments. Have you ever experienced a butterfly effect situation? How did you handle it? I'd love to hear your stories. See you next time.